Welcome to Elite Acquisitions and Investment Banking, your number one source of information in M&A coming straight from the trenches. Today I put together this M&A Crash Course to walk you through the process. I've noticed there's a lot of misinformation and not only that, but misguidance in regards to your path of M&A. How do you get started? What you should look for and how you should execute. So this is the table of contents. We're going to start with mergers and acquisitions. What is it? It is used together, but they mean two different things. What's your plan? Do you need a team? Accounting and law firms. Deal flow. Deal analysis. Reasons why someone sells. Making offers. Financing. Equity gaps. Post-acquisition. And of course, please subscribe. So let's start with mergers and acquisitions. What is the definition of it? What are mergers? A merger is an agreement that unites two existing companies into one new company. There are several types of mergers and also several reasons why companies complete mergers. Mergers and acquisitions are commonly done to expand a company's reach, expand into new segments, or gain market share. When you're starting out, you're not focusing on mergers, but acquisitions. So let's talk about that. An acquisition is when one company purchases most or all of another company's shares to gain control of that company. Purchasing more than 50% of a target's firm's stock and other assets allows the acquirer to make decisions about the newly acquired assets without the approval of the company's other shareholders. So now that you understand what's a merger, what's an acquisition, let's talk about what's your plan. And a lot of people say, I'm looking to acquire a business, and they get stuck and they don't know how to grow it. So let's talk about growth models. We have a roll-up. Everybody's heard about a roll-up. What is it? A roll-up is a process used by investors where multiple small companies in the same market are acquired and merge. Now, the thing about the roll-up is that it limits your options to one specific type of company. I'm not interested in that. I'm looking for market dominance. I'm looking for expansion. So I'm more interested in a buy and build. So let's talk about that. A buy and build strategy is commonly used by private equity firms seeking to expand operations, generate value, and increase returns. It is accomplished through the acquisition of a platform company with already established internal capabilities that can be further built upon. Let me give you an example. In healthcare, we're looking at physician offices. And larger physician offices, say in the $2 million plus range of annual revenue, usually have multiple rooms. And a lot of those rooms are empty. So what we could do is we can bring other doctors or physicians to provide services that work in conjunction with the services already being provided. Taking advantage of the current company we have, we just add on to it to increase not only the amount of services being provided, but our ability to expand into other segments under one roof. Let's talk about a one-stop shop. Now, the difference between a buy and build and a one-stop shop is that a one-stop shop has a larger growth ratio, and a buy and build is more of that company itself. So a one-stop shop firm is a firm that offers a multitude of products or services to its customers, all under one roof, so to speak. Compared to visiting a separate institution for each area of need, the one-stop shop saves the customers a lot of time and effort. Let me share with you why Amazon became so big. Now, when you go on Amazon and you swipe your credit card, you're either getting a product, which is what you bought, you're getting the product, or you're getting a refund, correct? It is that trust they built that allowed them to expand their platform and to offer multiple products. People are more willing to purchase multiple products or services from one trusted provider than just buy one and figure out the rest. Let me give you a good example when it comes to construction companies. So say I got a roofing company and a guy, his name is John, hires me to do his roof. We get the job done in a timely fashion, using adequate methods and proper tools and equipment. And John likes the finished product. He saw the value we provided to him. He saw we were reliable and he was able to trust us. Now, the problem is we only do roofing. So that's where it dies. Now, John has to go and find somebody else that can provide other services that he might need, say plumbing, heating, HVAC, and hopefully he gets the same level of service. Instead, we can leverage what we call our market capital or market equity, that the people that already trust us, we will provide more service to them. Remember, the best sell is not the new sell, but the old sell. If you could get your existing customers to purchase more from you, it creates loyalty. And that's what we want. So now we do roofing, we do plumbing, we do landscaping. And instead of just offering one side of things, we finish the roof and we're like, John, I saw, your bushes need a little trimming. I saw we could fix the plumbing. There's some issues with that. I can make you a package, get it all done. You already know the level of service we provide. And he will be more willing to move forward with you because it's more convenient for him to get the job done with you and know you're a reliable source for all his needs instead of him finding somebody else. So one-stop shops are great. Keep them in mind. You're building a brand and you're building loyalty with that brand. Turnarounds. Unless you got massive capital backing, I'm not going to touch those starting out. Let's talk about what it is. With this one, the private equity firm acquires equity in the company rather than debt, usually before a bankruptcy process begins, and then attempts to restructure the company and get it out of distress. I'm seeing it this way. I got a main I got my main company, and I see this one medical practice. They got great technologies. They got great systems. Problem is they lacked in marketing. And because of that, they weren't able to generate the revenues or the cash flows they needed to maintain operations. So I could come in and do a turnaround with this business and take it over. So it has to be strategic. Let's talk about, do you need a team? Now, we have multiple videos on this topic you could refer to. ANSI has plenty videos on it. I have a video that basically walks you through the process of getting your board done. So what is a deal team and what is a board of directors? A deal team is a team of professionals who support the business owner in planning and executing a transaction. We're talking about your transaction attorney, your CPA, your investment banker, so on and so forth. These are guys that are going to help you complete transactions. That is mostly if you're a private company. It allows you to move swiftly and execute precisely. Now, if you're a public company, there has to be more structure to it. And the more people you got to go through, the slower the process gets. So that's where the board of director comes in. A board of directors is an executive committee that jointly supervises activities of an organization, which can be either a for-profit or a non-profit organization, such as a business, a non-profit, or a government agency. Now, the board of directors will constitute of, we got the CFO, we have the chairman, we have a CEO, we have a CFO. We got guys that are overseeing the operations. Now, the board of directors is not the management team, so you're going to have somebody separate, but the board of directors is going to oversee the management team. If you want to learn more in depth about this, check out our other videos. I'll link them in the description. Let's talk about accounting and law firms. This is the big question. Do I need big four accounting firms? Do I need to pay $100,000 for due diligence? I'll tell you. So law firms and accounting firms, here's the definition so you're not confused. But you don't need a big four accounting firm or a law firm starting out. You just need a regional firm. A regional firm will do well. And sometimes regional firms are more specialized and they have ex-big four guys working for them. So they could provide you that level of quality, maybe even more in-depth quality, uh, because they're more specialized at a fraction of the price. So that's something you want to go with. And you'll be looking at a quality of earnings report. And with that, the bank will be able to lend you. Now, deal flow. Let me go back to law firms and accounting firms. Now, before you even reach out to a law firm or an accounting firm, you're going to need an LOI. The LOI is going to show seriousness. I've heard of a lot of people say reach out to them, pitch them, try to get deferred fees. But there's something called leverage negotiations, meaning whatever you ask for, you have to provide something of equal or greater value. You telling them what you're going to do means nothing because you haven't done anything. Instead, you come to them, hey, Mr. Law Firm, hey, Mr. Accounting Firm, I have a transaction, I have a deal. We analyzed it with our team. Overall, it looks well. We were able to structure a price in terms that make sense. And is this something you'd be interested in moving forward with? And if you want to get deferred fees, don't say the word deferred fees or success fees, because that supposes it's going to take a couple transactions till you get something done. You want to show confidence. The word is post-transaction payment, because you assume the deal is going to get done, and after it gets completed, they'll receive their payment. Now let's talk about deal flow. These are sources of deal flow. We have broker firms, we have off-market, and we have investment banks. Now, when it comes down to the quality, broker firms don't have great quality deals. I've gone through about 100, maybe saw one, but due to the price and the structure they had in mind, we couldn't come to an agreement. Off-market, I left it blank because quality is a hit or miss. You really don't know the numbers until you start digging in. And investment banks, they're the more professional, so quality is there. Now, quantity, you're going to get that quantity with broker firms, but it's more of a quantity over quality. Investment banks, you're getting quantity and the quality. So keep that in mind. The difference is broker firms, you could just go over the deals, and with investment banks, you're going to have to put up a retainer. Now, off market, there is quantity, but the numbers are about 1 to 3 business owners you get to speak with per 100 calls. And from there, you get maybe 1 discovery call, and then how many discovery calls till you receive financials. So it's large numbers. It's a large number game. But in the end, like I said, it's a hit or miss. It's more of a 50-50 instead of a 90-10. You'll find good deals. We have members who found great deals. We're talking about $20 million deals. One guy is looking at buying a large exchange firm. They do stocks, bonds, crypto. There's a lot of options. Now, price. Broker firms, I put the price on blank because it's more of a betting war. It's more of a betting war when it comes to them. They don't like to lower the price. It's more about term adjustment. It just comes down to your ability to negotiate. Off market price, yes, you will be getting the better price because you'll have to negotiate, and you'll have to basically, if you could pitch an offer that makes sense, they'll most likely go with it. Investment banks, prices make more sense. It just comes down to the deal and the seller. Reliability, broker firms, do not rely on them. Off market, really don't rely on them. Investment banks, you get what you pay for. Now, if you ask me personally what I do, I go off market. I know how to swim in those waters. I know how to navigate them. So I really have no issues. What I'd recommend for all those people starting out is go through broker firms, get a couple deals, look at a couple numbers, familiarize yourself with them. And then once you have the confidence, you can start diving into the trenches, like they say. In regards to resources, here's some links. Business brokers, Axio.net, business brokers, off market. Yellow Pages, DNB Business Directory, and investment banks, you can go to axial.net, investment banks. Deal analysis. Now, this is once we start diving deeper into it. So let me show you my preliminary analysis chart. And this to run preliminary analysis on deals before we even go in depth. So first thing is annualization. Now it is not accurate, but it could provide you an image of how the numbers could look like. Now, for example, the business we're looking at has a quarter of data. It's about 3 months. So we have a quarter. It's 4 quarters in a year. And the first quarter is $250,000. So we put in the amount we have by the number of months. It's 3 months. And it get this amount divided by 3 and multiply times 12, which assumes $1 million of cash flow in a 12-month period. Now, when it comes down to this is used for when you have incomplete sets of financials and you want to get an idea without going too in depth into pro forma. Now, let's talk about financial strength, the assets to liabilities. Now, this is more of if there's a liquidation in case we cannot pay debt and we have to use the assets or the total current assets to cover the liabilities. Can we cover them, and how many times can we cover them? So if our total current assets and our total current liabilities are exactly the same, we could cover it once. After that, we lose our assets. If we have more assets and liabilities, say our assets is 50,000, well, we could cover it 4 times. This is like your DSCR. How many times can you service debt? The greater the amount, the better. Now, the issue arises when there's more liabilities than assets, because that will take you into a deficit. And when you reach that deficit, you got to compensate by your own cash flow injection. Now let's look at the financial strength indicator. This is more of an overview. What are the total assets to total liabilities? Not current, but the total overall assets. And what we want to look at here is during the previous years, 2018, 2019, 2020, has assets increased while liabilities decreased? Has liabilities increased while assets decreased? Or are they almost on the same pattern? And that will tell us the financial strength of the company. Now, taxes to reported earnings. Now, when it comes to business owners, the numbers, they get taxed on net income. So private businesses want to report the least amount of net income as possible. So they get taxed the least. So they would report that on the taxable income. Now, if your profit and loss net income states, say, 250,000, but your taxable income, they only stated 175, well, there's a difference of about 30%. And anything over than 15% is an issue. Now, when it comes down to the huge numbers, like, say, net income is 750, and their reported income is only 500,000. Well, that's a difference of 33%. And the larger the numbers, the more of a difference, you will most likely not get funded. That's a red flag. Those are not true and accurate numbers, and that is a risk for any investor or any lender. Now, receivables to payables. This is another important key aspect. Now, receivables is services we've rendered that we have to collect on. And payables is services that have been rendered to us and we got to pay. So do we have to pay more than what we have to collect on? Or are we going to collect on more than what we have to pay? That gives you another thing to look at. Now, banks, what are they interested in? Banks are interested in volatility. Throughout the years, how has volatility been? And we know 2020 was the pandemic. So we'd add 2021 and we'd see how much it dropped compared to a previous year and how much did it bounce back by. And if it did a good comeback, then you're basically in the green. If it's still declining or it didn't come back strong, then that's something to be more worried about. I've seen deals where percentages are like 80%, then 3,000%, then 500%. The problem about massive growths or growth spikes that break the chart, so to speak, is, do we know they're going to continue? Because if not, we're making an assumption and we're assuming it's going to continue. So we make an offer on that and then the next year it doesn't. And now we overpaid and we don't have the cash flows to maintain that debt service. So you got to understand the value of a business is its cash flow divided by its risk. What is the risk associated with cash flow? Everybody takes a look at the numbers and assumes that's going to be the cash flow continuum for years to come. But they don't understand, is that a one-time thing? Is it a contract? How long is the contract? So on and so forth. Then we'd come down here and we'd have the balance sheet. And we want to see what is the total check-ins or savings throughout the years. How has it grown? And this will give us our preliminary check. It's very simple, but the amount of deals that don't pass through this is amazing. And I made this myself, if you wanted to know. Now, this saves me so much time. How can you get access to these resources and materials? The members do. So consider becoming a member. Now, let's move back into our presentation. Reasons why they sell. Who are they? The business owners, of course. Now, reasons why somebody would sell their business. First, we got money. Usually, the business owner is in need of money and thus are more desperate. They're looking for the majority down, which will limit how much they can receive. This is what people usually call the motivated seller. The truth of the matter is motivated sellers don't exist. What you have is desperate sellers. If you want somebody who's motivated, go to a broker firm, go to an investment bank. You have people that are looking to sell. People that are off market usually are not interested in selling. Reason is they got something good. Why do they want to get rid of it? So their level of motivation is them basically booking a discovery call with you. If you could book a discovery call with an off-market deal, they're interested in hearing what you have to say. Then it's up to you to pitch them, right? Now, the thing about money is usually because they want the majority down, you have to adjust for your metrics. Are we doing a 2 times DSCR, so to speak? So if we're doing 2 times DSCR and it's doing $1 million cash flow, we could offer them about 2 million or so. If it's doing 500,000, we could offer them $1 million, because you got to understand the multiple you buy it at is basically the amount of years that it takes to pay off that debt. So something when it comes down to money is usually 1 or 2 times. That's what you're looking at. Now, time. Usually the business owner's interested in retiring or playing a smaller role in the company. You can open up the conversation of seller finance to save on taxes. Now, when I reach out to off-market deals, I'm never saying, hey, John, have you thought about selling your business? Because selling means getting rid of something. What if they don't want to get rid of it? I word it like, hey, John, have you thought about retiring or expanding? That's different. Now, when it comes to retirement, what I want to figure out is how much money do they need right now today so they could retire? Say they need $500,000 and they're doing, give or take, 300,000 free cash flow. So on a 4 times us, about 1.2 million. 500,000 down is about, give or take, 40% of the total amount. But the difference is you're able to Seller finance, and the beauty about seller finance is that terms are flexible. So let's say we could do 7 or 10 years. And if we do 7 or 10 years, they're not only collecting on the principal, but they're collecting on the interest, which means not only are they saving on taxes because of the 40% plus capital gain tax, but you're building them a retirement plan. So it's basically how you word it. I word it as in, instead of us getting the bank involved, you essentially become the bank. And I tell them, John, do you know how banks make money? And they're like, by lending money, right? And I'm like, yeah, they make money on interest. So if you become the bank, not only are you getting your principal, but you're cashing in on interest. And if we structure this over 7 or 10 years, think of it as a retirement plan. The thing here is, I don't want you to outlive your money. And that is a big problem that happens with retirees. It's about how you word things. A lot of the other guys or the gurus, they lack negotiation skills. So they try to take a more aggressive approach, and they don't understand. Business owners or small business owners have an emotional attachment with the business. So it's up to you how you word things. Now, expansion. Usually the business owner is interested in expanding his business, but currently does not have the time, money, or resources to do so. They're more interested in retaining equity. So when I pitch somebody expansion, we're talking about implementing either a buy and build model or a one-stop shop model. After they agree to it, I talk about usually when somebody sells, they want to get the most they can out of it. It's just common sense, right? You worked in the business for so many years. You want to get the most out of it. Now, I tell them, John, I understand you're looking to get the most out of your business, but the major reason why businesses go bust is because of lack of cash flows. We don't want to over leverage the cash flows to a point. We're just paying debt and we don't have any working capital to keep operations going. And then we're going to have to lay off people, and that's when the business starts failing. So we're looking to maintain cash flows. We're looking to establish a dominant position in the marketplace. And we're looking to have cash in hand to basically buy into opportunities or take out the competition. So that's when we talk about a small down payment, some seller finance, and some equity retention. Because if they want to be a part of the expansion, wouldn't it make sense for them to cash on the growth, on the upside? It's how you word things. Now let's talk about making offers. How to make an offer. An offer is constructed by 3 parts. First is the business financials. This will let you know how much debt you're going to be able to service alongside the strength of the cash flows. The owner needs and prompts, motivations to sell, and current issues they face. That's the second. First is financial. Second is the owner's needs and prompts. And third is the lender's financial requirements you have to adhere to. Either be banks, investors, private equity. Either be a return on investment, DSCR, or whatnot. Stop shooting blind offers and doing multiples and comparables. Most of your offers is solely focused on the financials and lender requirements, but forget about the motivations and issues the seller has. All of this falls down to your ability to negotiate a transaction. The problem with comparables and multiples is that they don't take into consideration cash flow. How so? What is the value of a multiple? Tell me that. It has none. The value is basically whatever the cash flow is. So a multiple could be $1 or $1 million. Taking that into consideration, one multiple can make a huge difference and can lead to overpaying. So the way I structure my offers is I want to make sure I'm hitting my financial metrics, either be my internal rate of return, DSCR, and multiples. So y'all have an idea. Comparables? Anybody that says they can compare private businesses are lying to you. They're bullshitting. You can't. How can you compare a private business? There's about 8 metrics you have to meet in order to compare a business. And there's 6 of them that must be met. Meaning out of 8, 6 have to be met. And you got to compare about 12 businesses that are exactly the same for you to get a comparable. So unless you understand the full infrastructure of the companies, you're guessing. So don't say, because this was a deli shop and it sold for 12 times and I'm a deli shop around the same area, I won 12 times. That's not how it works. The only way you could do comparables was with public companies because their information is out there. You cannot do them with private companies. So anybody who tells you that lack valuation knowledge. And that is certainly true for the majority of people peddling misinformation. And why is that? Because it's simpler to lie to you. How do you make things simple? By shortcutting. And shortcuts always lead to larger issues. So take that in mind. Financing. Getting funded. That's the name of the game. That's the last part, right? So what options do we have? We have commercial debt. Up to 60% financing. It does not dilute holding equity, and there's low interest rates. Now you're like, what do you mean 60%? Well, commercial banks will only fund up to 60%. Then you got to make up the difference. But 10% for a fact has to be equity infusion, either from your part or from an investor. Unless you're looking to become an owner-operator, you want to go with commercial debt. And I don't know if you guys know, but the SBA favors owner-operators. With that said, if you acquire a business with the SBA, there's a $5 million limit for life per person. It's not per deal. And you're going to be stuck operating the business for the next 10 years. So unless you're looking to become an owner-operator, use commercial debt. But the gurus won't tell you that. Private equity, up to 100% financing. They will assume you're holding equity as you have no skin in the game. Just makes sense. If they're putting the money, they'll take control of the company. And it's what is called a convertible note, meaning if you keep operations going smoothly, they'll leave you alone. But if not, they'll just convert to equity and just take it from you. Seller finance, up to 100% financing, very flexible terms, and the seller saves on taxes. I love it. Third world countries, especially in Latin America, when banks will only fund a very small portion and debt is expensive, the next best alternative is seller finance. So go with that. Equity gaps. Now, this is something else the gurus won't tell you. What do they say when it comes to investors? I'll just pitch them. Make a pitch deck. If it was that simple, right? There's the thing about investors. When you're getting investors, they're usually passive investors, unless it's an active business partner. But passive investors are protected by the SEC, and there's regulations you have to follow. That means you need a fund. They're not going to deposit the money in your account. Why? So you could take it and run? That's not how it works. You're going to need a fund. You're going to have to set that fund up with your CFO. And that is going to include a PPM. It's going to include the Investor's Bible, which outlines the terms and conditions. You know, there's the rate of return you're going to get. This is what happens if we can't pay or we default. And then it comes down to the strength of the deal. Now, another thing they won't tell you is if you can provide investors a risk-free rate of return, that'll give you a better chance of them backing you. A lot of guys that say, well, I'm providing investors a 15% rate of return. Well, are you basing that on the assumption of cash flows continuum for the term length? Or are you guaranteeing that as a risk-free rate? Different levels, so keep that in mind. Now let's talk about post-acquisition. What happens after we do that one deal? We get the deal done. Now what's the next best thing? Let's talk about building a sales team. Instead of you wasting your time, because time is money, and now you have money to hire people, you have leverage. Instead of you wasting your time on cold leads, get a sales team and then book the discovery calls, and then you could just focus on warm leads. That's one way you could do it. Another way is you can hire an investment bank. A lower middle market investment bank will do the whole process of a transaction, from reaching out to getting it funded. It's going to cost you a pretty penny, but you're spending almost no time on it. They're going to handle it. Time is money. Let the experts handle it, right? Implement technology, making things more efficient. Now, there's a lot of people that are interested in technological companies. I know technology is hot, but it's how you leverage it. Let me give you an example. A doctor's office that has telehealth could sell from anywhere between 8 to 12 times. What is telehealth? It's really just a doctor with an iPad. So if you buy an iPad and give that to a doctor and it increases your business by 8 to 12 times, you tell me if that's a great return on investment. So instead of you buying a business at a 10 to 12 times rate, you could buy a normal doctor's office for about 2 to 4 times and then implement the technologies that will increase it. The whole rule of the game is buy low, sell high. Isn't that what we say about stocks? Buy low, sell high. Well, buying businesses is the same thing as buying stocks because you're buying shares of a company. So why are you going to overpay and use metrics like EBITDA, or not even that, buy things that are overvalued when you can buy them low and then increase the valuation yourself? Be smart. Market innovation. You want to find a problem pattern and offer a solution. What's a problem pattern? I'll tell you. A lot of people say find a problem. Well, how do you know it's really a problem that a lot of people face, or it's just a one-person problem? As you speak with many business owners, ask them, what current challenges you see, what current issues you face. Do you think you can make, the company better in any way, operations better, whatnot? And find a pattern between these business owners that they tell you, these are issues we face. These are usually the problems we have. This is what's costing us the most overhead. And if you can offer them a solution or create a solution to offer to a marketplace, you're basically innovating, and the billions are made through innovation. And then market dominance. Money follows attention, like Grant Cardone said. Establish your image. Build your image. Market yourself. Let people know you're in the market, and that's the way you'll be found. And because you'll be found, they're going to go to you. Simple as that. Now, I'm killing it here. I appreciate your time. This is Elite Acquisitions and Investment Banking, and we're here to provide the highest level of quality to our viewers, to our members. Information straight from the trenches. Nothing but details. We don't dwell with generalities. With that said, subscribe and share. And if you're interested, become a member. We're going to have a link below. Thank you very much.